You've heard the word Nifty 50 hundreds of times. On the news, in conversations, on your trading app. But do you actually know what it is, how it works, and why it matters for your money? In the next 8 minutes, I'm going to explain the Nifty 50 completely in plain language. By the end of this video, you'll understand something that most Indian investors use daily, but very few actually understand. Welcome back to Market Mindset, where we break down the stock market clearly, honestly, and without the noise. If this is your first video, we post every Tuesday, Thursday, and Saturday. Today, we're covering one of the most fundamental concepts in Indian investing, the Nifty 50. So what exactly is the Nifty 50? Simply put, it is an index. An index is not a stock you can buy directly. It's a measurement. Think of it like a thermometer for the Indian economy. Just like a thermometer tells you the temperature of a room, the Nifty 50 tells you the temperature of India's top 50 companies. When Nifty goes up, it means on average, India's biggest companies are doing well. When Nifty goes down, it means on average, those companies are struggling. The Nifty 50 is managed by the National Stock Exchange of India, the NSE. It was launched in 1996 and since then has become the single most watched number in Indian finance. How is Nifty 50 calculated? The index is calculated using something called free float market capitalization. Don't let that term scare you. Here's what it means in simple language. Market capitalization means the total value of a company, calculated by multiplying its share price by the number of shares available. Free float means only the shares available for public trading are counted, not the shares held by promoters or the government. The 50 companies with the highest free float market cap on the NSE form the Nifty 50. Their values are combined and tracked as one number. When that number rises, Nifty is up. When it falls, Nifty is down. Which companies are in the Nifty 50? The index includes the 50 largest and most liquid companies listed on the NSE across different sectors. Right now, the Nifty 50 includes companies like Reliance Industries, TCS, HDFC Bank, Infosys, ICICI Bank, Kotak Mahindra Bank, Larsen and Toubro, Axis Bank, Bajaj Finance, and Hindustan Unilever, among others. These are not random companies, they are the backbone of the Indian economy. Together, they represent over 13 different sectors: financial services, IT, oil and gas, consumer goods, automobiles, pharma, and more. This diversification is one of the most powerful things about the Nifty 50. No single company or sector can crash the entire index. The composition of the Nifty 50 is reviewed every 6 months by a committee at NSE. Companies that no longer meet the criteria are removed and replaced by stronger ones. This means the index is always self-updating. It automatically removes weak companies and adds stronger ones. As an investor, this is enormously powerful. Now, what do Nifty movements actually mean for your portfolio? When you hear Nifty is up 200 points today, what does that mean practically? It means the combined value of India's top 50 companies increased by a certain percentage. If you own stocks in companies that are part of the Nifty 50, your portfolio likely moved in the same direction. But here's what most beginners miss. Daily. Nifty movements mean almost nothing for long-term investors. What matters is the trend over months and years. The Nifty 50 has grown from around 1,000 points in 1996 to over 22,000 points today. That's more than 2,000% growth in under 30 years. Anyone who simply stayed invested through all the crashes, 2008, 2020 COVID, came out significantly wealthier on the other side. So how can you actually invest in the Nifty 50? There are two main ways. The first way is through index mutual funds. These are funds that simply buy all 50 stocks in the Nifty 50 in the same proportion as the index. When Nifty goes up 10%, your fund goes up approximately 10%. When it falls with it. The cost of these funds is extremely low, typically 0.1% to 0.2% per year, making them one of the most cost-efficient investments available to Indian retail investors. You can start a SIP, Systematic Investment Plan, in a Nifty 50 index fund with as little as 500 rupees per month through any mutual fund app. The second way is through ETFs, exchange-traded funds. A Nifty 50 ETF works exactly like an index fund, but trades on the stock exchange like a regular stock. You can buy and sell it any time during market hours. Popular options include Nippon India Nifty 50 BIS and HDFC Nifty 50 ETF. Both track the Nifty 50 very closely and have extremely low expense ratios. For most beginners, set a simple Nifty 50 Index Fund SIP of even 1,000 rupees per month started today and continued for 20 years will outperform the majority of actively managed funds. This is not an opinion. It is backed by decades of data. So to summarize, the Nifty 50 is an index that tracks India's 50 largest companies by free float market capitalization. It is the most important number in Indian finance. It is self-updating, diversified across sectors, and has delivered over 2,000% returns since 1996. You can invest in it directly through index mutual funds or ETFs, starting with as little as 500 rupees per month. If this video gave you clarity on something you've heard about but never fully understood, subscribe to Market Mindset. We post every Tuesday, Thursday, and Saturday. Drop a comment. Are you already investing in Nifty 50 or are you just starting? I read every single one. This is educational content only. Do your own research before making any investment decisions. See you Saturday.